Effective for tax years beginning on or after January 1st, 2013, California has made it mandatory for businesses to use single sales factor apportionment and market-based sourcing for sales of other than tangible personal property. These rules will determine whether a taxpayer is doing business in California. Under a market-based sourcing approach, receipts from services are sourced to California to the extent the purchaser receives the benefit of the service in California. Under the new rules, a physical presence is no longer necessary for a taxpayer to be deemed doing business in California. For 2013, a management company will be deemed as doing business in California if its gross management fee revenue from California sources exceeds the lesser of $509,500 or 25% of its total gross management fees. The company will be required to pay a nominal annual tax, and if it's a limited liability company, an annual fee of up to $11,790. The management company will also be required to withhold and remit as tax 7% on distributions of California source income made to non-resident partners when distributions to the partner exceed $1,500. Amounts withheld represent tax payments made by the partner. An individual will be taxed on 100% of his allocable share of income from the management company in their state of residence. The individual is generally allowed a credit against his resident state tax liability for taxes paid to another state on the same income. The credit is limited to the amount of tax on this income in their home state. A New York State resident who receives an allocation of $1,000 from a New York-based manager will pay New York tax at 8.82%, or about $88. If, under the new rules, 30% of the management fee revenue is sourced to California, the individual owner will also owe California tax at 13.3%, or roughly $40. The individual may claim a credit against his New York tax for California taxes paid of about $26. This is the $300 of California income multiplied by the New York rate. So the total tax is just over $100, whereas prior to 2013, the total tax would have only been the $88 of New York tax. The increase represents the difference between the two rates applied to the California income. It is important to note the possibility that New York can challenge a credit for the California tax, as states generally only permit credits for taxes paid to other states if the income was sourced under rules similar to the home state. However, there has been some informal indication that New York may not challenge credits in such a scenario. I've only focused on one scenario, but there are other issues that arise depending upon where the management company is based and where the individual owners reside. A non-exhaustive list of issues include the ability of individuals to claim California tax credits in their home state, whether a California-based manager can source receipts outside of California under the new rules without invoking the throwback rule, and whether a non-US based manager having no federal nexus can be deemed to be doing business in California. To learn more about whether or not California's market-based sourcing impacts your individual situation, contact your Untracked Early advisor. I'm Rich Cagnetta with Untracked Early.